Yesterday we closed above 84, like 84.60 spot silver. So that's bullish. We're up about 18% in both gold and silver year to date. It was the first week in a month that silver was up on the week. And gold, Elijah, actually it closed just above 5,100 on the spot yesterday. At $100, it's easier for central banks to keep silver than at $20. It's not as bulky. The industrial demand situation hasn't changed. There's a silver deficit. All the proxy wars, talk of wars should help silver, because silver is really important, not just for industry, but also for defense. I think it was Jim Sinclair who said you need to try to be your own central bank and have your own gold and silver reserves. And central banks, they don't take profit on gold and silver because it's money. Gold and silver and the miners are already outperforming in 2026. So how long more can these people ignore gold and silver and commodities?
Precious metals have reacted positively to the news, rallying quite a bit on Friday. Silver back above $80, gold back above 5,000. And these seem, I guess, relatively low compared to where we were a month ago before the big crash in silver, but it is crazy to think that they're still significantly up on the year. Your latest video pointed out how we should really be focusing on kind of the long-term trend, how investors are moving away from risk assets into safe havens, and that trend seems to be still intact despite the short-term volatility. So your take on where we are right now in the precious metals?
Yeah, like I said in my latest video, we're up about 18% in both gold and silver year to date, while the S&P is up less than 1% year to date. NASDAQ is down 1% year to date. And if you remember back in December, at the time, I think it was sometime just before Christmas, silver traded up to 84. And then it crashed on Boxing Day, which is the day after Christmas. We call that here in the UK. It crashed to 70. So yesterday we closed above 84, like 84.60 spot silver. So that's bullish.
Precious metals are rallying. Yet most investors ignore that their year-to-date gains dwarf mainstream indices. Silver and gold are up roughly 18% YTD, while the S&P is essentially flat and NASDAQ slightly negative, a divergence Mario Innecco highlighted in his latest market review. The spike above $84 in silver post-Boxing Day demonstrates sustained buying pressure despite short-term volatility, suggesting safe haven demand remains robust. For portfolios, this signals that traditional risk assets are underperforming against hard assets. Strategic positioning in metals could offset potential equity underperformance in 2026.
A lot of people have been talking about taking profits in gold and silver, especially when silver was like $100 an ounce and stuff. If we think of the long term, right, 5-10 years down the road, do you think that is going to be a mistake of taking profits at these levels, where obviously we're off from those levels, right? From $5,500 gold, $120 silver. Those who took profits are probably feeling pretty good right now. But if we look 5-10 years down the road, do you think we'll look back at that and see those as pretty good prices for the metals?
Yeah, I try to look at gold and silver more as a monetary asset, like a saving instrument. And there are people who don't look at it like that, who don't understand the monetary nature of gold and silver, and they trade it like through the futures or ETFs. And maybe in the short term it is time to take profit. But even then, I don't think it is anymore. I think the time to take profit would have been like at the end of January. But I think it was Jim Sinclair who said you need to try to be your own central bank and have your own gold and silver reserves. And central banks, they don't take profit on gold and silver because it's money. So that's the way I look at it.
Profit-taking in gold and silver may feel rational, yet it ignores the long-term monetary function of these metals. Mario Innecco points out that while silver briefly touched $100 and gold $5,500, central banks maintain positions without selling. highlighting that these are stores of money, not tradable commodities. For investors, this means short-term gains may mislead, as the long-term purchasing power and hedge against fiat erosion remain intact. Treating metals like ETFs risks missing their wealth preservation role. Next, Mario Innecco examines why looking 5 to 10 years ahead could reshape portfolio strategy fundamentally.
If you look at Venezuela back in 2017, just before their hyperinflation, you would have done well at one point to take profit. I think it was 10,000 bolivars an ounce, and then it dropped to 6, and you might have taken profit and felt really clever. But then in a year and a half or two, that currency was just gone and silver was priceless. And I think we're going towards that kind of environment. It might not be as extreme as Venezuela, but it's going to be inflationary. So yeah, unless you have something that you want to buy, some kind of other investment that you find attractive relative to gold, or if you have an emergency, I personally wouldn't be getting rid of my gold and silver to park it in, dying fiat currencies. That's the way I look at it.
It is interesting, as we've seen the bull market progress, we have seen pullbacks here and there. This one just, I guess, felt especially dramatic, right? Where you see silver fall 25% in a day, intraday, I think it was 30-some%. And you've just seen kind of waterfall selling certain points here and there after that. I remember back in October, right, when silver went from $54 to, was it 45 around was the low. Everyone was saying, well, the bull market is over, the bull market is over.
Short-term corrections in silver may feel alarming, but historical precedent shows panic can be costly. Mario Innecco cites Venezuela 2017, where selling at 10,000 bolívares per ounce would have missed the metal becoming invaluable as fiat collapsed. Today, similar inflationary pressures suggest that divesting gold and silver into weak currencies risks permanent opportunity loss. Investors should view steep intraday drops, like 25 to 30%, as volatility signals rather than exits, keeping allocation steady to preserve purchasing power. Next, Mario Innecco details why these sell-offs often mask the accumulation phase for strategic investors.
Well, we went to 120 after that. So if you take these sell-offs maybe as buying opportunities, that might be a better option. I mean, do you see anything particularly unique about this last sell-off, signaling that this one might be different than the ones we've seen previously? Or do you think, within a few months we could just be at all-time highs again?
Well, I think the higher we go in gold and silver, the more extreme these corrections are going to get. But if you look at a few years back, it would have taken a long time for the market to recover. Like you talked about how we dropped from like 55 or 54 to 45, and then it came back really quickly. This time around, I guess we dropped from 121. I think the recent low was around 64, if I'm not mistaken. And now we're at 84. Yes, it's taking a little longer, I think, than in December. Or it was October when it dropped 54 to 45. But that's because it's been such a much bigger move. So, yeah, I think the other thing as well, in the end of January, there's a lot of coordination between the bullion banks to make sure they got gold and silver down, because especially silver, because they were caught short and they needed to get it down.
The latest silver correction isn't just volatility. It's strategic market manipulation by bullion banks. Mario Innecco notes that despite a drop from 121 to 64, recovery to 84 shows resilience. Yet coordination by large institutions in January suggests engineered dips to cover short positions. Investors need to differentiate between normal pullbacks and orchestrated market moves, as these influence timing and allocation decisions. Long-term holders may see this as a buying opportunity rather than a trigger to exit. Next, Mario Innecco explains why understanding bullion bank activity is crucial for safe metal accumulation.
So they took to cover their paper shorts. And but the problem with that is there's still heavy physical demand for silver, which we didn't have years ago. People were okay just trading paper. So the more they try to knock it down, the more the people like the Indians and the Middle Eastern countries and China, the more they will want to buy the silver, because the higher it goes as well, the price, the more interesting it becomes as a monetary reserve, because it's at $100, it's easier for central banks to keep silver than at $20. It's not as bulky. And the industrial demand situation hasn't changed. There's a silver deficit. And also the geopolitical uncertainty and all the proxy wars and all the talk of wars should help silver, because silver is really important, not just for industry but also for defense. So that's the way I see it.
You've mentioned also how for retirement accounts, there might be a move into safe havens like gold and silver as well. What do you make of this, I guess, general trend towards the metals that's starting? It's not a huge trend at the moment, but it's at least starting for mainstream investors.
Despite orchestrated paper short squeezes, physical silver demand is surging, signaling deeper structural support. Mario Innecco observes strong buying from India, the Middle East and China, reflecting central banks' interest in storing silver as a monetary reserve rather than speculative trading. Coupled with a persistent silver deficit and geopolitical uncertainty, this demand underpins long-term value, suggesting retail investors and 401k allocations could increasingly flow into metals. Short-term market dips are unlikely to deter these fundamentals. Next, Mario Innecco illustrates why retirement funds could pivot toward precious metals in this evolving environment.
Yeah, back in August, I think it was, President Trump signed an executive order to make it more clear for fund managers where they can invest 401k funds. And I think there's about 10 to 12 trillion in 401ks. And I think it was the Department of Justice, I'm not sure which department, was supposed to come out with some kind of guidance by February this year. So it's not that they can't invest in this sector, the fund managers, just that they haven't really felt comfortable doing it regulatory-wise. But now with this executive order, I think it's going to be there's going to be more certainty. So I think, yes, a lot of fund managers are going to have to ask the question, because as I said in my video recently, gold and silver and the miners are already outperforming in 2026 the rest of the market, and they did the same thing in 2025. So how long more can these people ignore gold and silver and commodities? And I guess that really coincides with this new environment from the executive order. So I think there's a lot of room, a lot more room, and I think we're still in the first innings or so of the precious metals and commodity bull market.
Regulatory clarity is finally giving fund managers a reason to consider 401k allocations in metals, yet adoption may lag despite clear performance. Mario Innecco highlights that 10 to 12 trillion in 401ks could see structural inflows as gold, silver, and miners outperform broader markets in both 2025 and 2026. For long-term investors, this represents a potential shift in mainstream asset allocation, where regulatory hesitation previously limited exposure. Watching fund behavior could reveal early inflection points in the commodity bull market.
The other thing I noticed yesterday was the first week in a month that silver was up on the week. So I think that's encouraging. And gold, Elijah, actually, it closed just above 5,100 on the spot yesterday. So not only did it close above 5,000, but above 5,100. So yeah, I'm still encouraged by it. And also, aside from the tariff situation, we've got geopolitics, which is not improving either. So I think you want to cover that as well. I'll leave it up to you to tell me when you want to talk about that, but I could segue into it.
Certainly, and I think the situation with Iran currently is very telling of how that's impacting the markets. Just the latest geopolitical conflict it seems like we are getting ourselves into.
Yeah, and one of the worrying signs is that the U.S. has sent so much, a big fleet of ships to the Middle East. The other thing I noticed, a friend sent me a message earlier today that back last year when the U.S. bombed Iran, I think the day before there was an earthquake in Iran, low on the Richter scale, and just today, apparently there was another earthquake in Iran, and the speculation is that these are not really earthquakes. It's the Iranians doing nuclear testing underground.
Headlines touch silver's weekly gain, but they mask rising geopolitical risk. Gold climbed above $5,100, marking its first weekly positive move in a month. Yet Mario Innecco points out that the Middle East's tension, including Iran, may amplify volatility in hard assets. Observers note unusual seismic events potentially tied to nuclear tests, reflecting hidden market pressures beyond tariffs or macro data. Investors should weigh these tail risks, as military developments could trigger rapid commodity repricing, especially in metals like silver and gold. Next, Mario Innecco details how these geopolitical tensions could reshape broader commodity flows.
So, yeah, Trump said yesterday he was going to give Iran 15 days to agree to the terms that the Americans are giving them. But you never know. Something could happen this weekend. We're speaking here on the 21st of February on the Saturday. Oil, it seems to be taking off a little bit. It's around $66, the WTI. But I would expect it to go a lot higher if there's some kind of skirmish in Iran. And the worrying thing about Iran is that if Trump really goes after Iran, it could bring in Russia and China, and that would make it a very serious event.
You have mentioned how the Iran situation could really reshape commodity prices as a whole. Oil pricing, oil has been depressed for quite a long time. It's crazy that as all these other commodities, gold and silver included, have risen dramatically, oil is still around $60 a barrel, which just a few years ago is over $100, and back in 2008 over $100. So to think that we're still well below prices we've seen in the past, where a lot of other things are at all-time highs, it maybe highlights an opportunity in oil. Do you see that?
Oil's modest climb to $66 masks a structural opportunity in energy that many investors overlook. Mario Innecco emphasizes that geopolitical risks with Iran could push WTI far above current levels, especially if conflict drags in Russia or China. Historically, oil at $60 to $66 contrasts sharply with gold and silver near all-time highs, revealing a valuation gap. For portfolios, energy exposure may provide both hedging and growth potential against metals, assuming escalation triggers supply constraints. Timing and risk assessment are key, not speculative optimism. Next, Mario Innecco breaks down why these oil shifts matter beyond headline prices.
Yeah, I think it was North Star's bad charts. They have a pretty big following on X. They looked at the how correlated the oil price and the silver price are since 1860, and they seem to follow each other. And right now it's divergent. Oil needs to catch up with silver. And I don't think that silver will catch down, so to speak, with oil. So yeah, I think oil is looking good. A long-term chart, we're breaking out of a falling wedge, which is usually very bullish. Unfortunately, that might signal that there will be some kind of conflict in the Middle East. And I think about 20% of the daily oil production goes through the Strait of Hormuz. And there's always the fear that the Iranians might try to block that strait if a conflict starts, if the U.S. Bombs Iran, for example. Some people think, though, that the Americans might do some kind of, let's say, move like they did in Venezuela of just like neutralizing the leadership in Iran. So that wouldn't really be using all the weapons. I know they're sending a lot of warships to the area, but that could be a decoy, and they might be just interested in getting rid of the leadership in Iran.
Oil and silver have decoupled, a divergence not seen since the 19th century, hinting at a latent energy surge. Mario Innecco notes the long-term correlation since 1860, and technicals now show oil breaking out of a falling wedge, typically bullish. With roughly 20% of global oil passing through Hormuz, any geopolitical disruption could sharply affect prices. Investors should consider this structural imbalance for energy-heavy portfolios, not just metals, while evaluating the probability of targeted regime actions versus full-scale conflict. Next, Mario Innecco evaluates how such targeted maneuvers could still ripple through markets.
That might not really get the oil price that high, because they might just change the regime, and no shots, so to speak, will be fired, and there will be no kinetic conflict. So still uncertain about that. But oil, technically, though, it definitely looks like it's an opportunity.
Besides gold, silver, oil, do you see any other commodities that are undervalued at the moment?
Copper has done really well of late, and I think it's going to continue to go higher. The Bloomberg Commodity Index, I think it's up about 9% this year. So as a whole, I think commodities ex gold and silver are undervalued. So I would play it more like that.
Oil may not spike if conflicts remain targeted, yet technical setups suggest latent upside. Mario Innecco highlights copper's momentum alongside a Bloomberg Commodity Index gain of roughly 9% YTD, indicating broader commodity undervaluation outside metals. Investors should note that while regime change may limit immediate kinetic risk, structural supply and industrial demand for copper and energy remain supportive. Diversified commodity exposure could hedge against inflationary pressures overlooked by equity-centric strategies. Next, Mario Innecco explains why these commodity trends could underpin broader portfolio resilience in 2026.